I'm going to explain how Rich, one of our members in Yield School, is doing an average of 45.84% returns in a bear market by using liquidity pools. In other words, this is how to use liquidity pools. I'm not going to explain how to use liquidity pools by using analogies. Most people try to do this. They tell you that your crypto in a liquidity pool is like a house that is paying you rent, or that you can become your own bank and people are paying you interest on a loan. But these analogies are wrong. And there is a reason I don't rely on analogies generally. It's called the faulty analogy fallacy. You take two things that look alike on the surface and you compare them and you think that you get it. But it is underneath that surface where things are really important and actually matter, which is where they are different. And so you think you get it because of the analogy, but the analogy is actually teaching you something false. And for me, when I explain things, I'd rather be precise and true, because precise and true beats simple and false when it comes to crypto investing. Some background on me so you know where I'm coming from. I was a regulatory attorney at a Band 1 ranked law firm. I advise some of the top crypto exchanges in the world. I now run a consultancy that consults 1,600 independent crypto investors, which means me and my team, we're consulting on hundreds of millions in crypto capital. I'm also not a bad crypto investor myself. I took about a small $90,000 portfolio into over $1.1 million in about 2 years. And despite all of this, I'm not your lawyer and I'm not a financial advisor. You are responsible for your own decisions. This is not financial advice to you. A liquidity pool is a financial contract on the blockchain. Specifically, it is a smart contract, which is like a software-based financial contract on the blockchain that comes built in with rules on how to handle crypto assets. You do not need to understand these rules in detail, but you do need to understand what these rules do to you as an investor. Every liquidity pool, because it is a contract, it has two sides. On the one side is you. It's the passive side. It's the side that is making yield on your crypto capital, often 30%, 40%, sometimes even 50% yield and higher. On the other side of this contract is an active trader. This is the active side of the liquidity pool or active side of the contract, and they are using the capital you have placed into this financial contract, into this liquidity pool. People say this is lending. It isn't. You are not loaning your assets to somebody who is paying you interest on that loan. When you are on the passive side of a liquidity pool contract, which you will be if you're watching this, you are agreeing to put two different crypto assets into this liquidity pool, and you are agreeing to let somebody else on the other side of that liquidity pool, an active trader, trade those two different assets for which he will pay you a fee. And so when a trader comes along to your liquidity pool, he is literally going to sell one asset into that pool and he's going to buy the other asset from that pool. He's actively trading your capital against you. He pays a fee to do those trades, and that fee goes to you because you provided the capital that is enabling that trading. This is where the very high yield on a liquidity pool come from. You only want to be on the passive, depositing, yield-making side of a liquidity pool, on this side of the contract, when two things are true. First, when you are confident that the assets you're depositing into the liquidity pool are going to be stable or going to do well in the next bull run. And the second condition is that market conditions in the short term, or at least for the amount of time you're going to be in the liquidity pool, are flat or bearish, or at the very least, not about to turn bullish. If those two things are true, then a liquidity pool is good for you as a passive investor. And as long as the assets you've deposited are quality and will do well in the next bull run, or are stable, and the market condition is not about to turn bullish, then you are going to be on the winning side of this contract. Now, why is that? Well, let's talk about the assets first, and then the market conditions second. Why do you need to be confident that the assets you deposit into a liquidity pool need to be stable, or at the very least, going to do well in the next bull run? It is because you are not depositing dollars into a liquidity pool. You are depositing crypto. And so the question you need to answer is whether that crypto is worth holding in the first place. A meme coin liquidity pool might be offering you 1,000% in yield a year. But if its price drops to zero in 2 weeks, then who cares if you made 2 weeks worth of 1,000% yield? High yield does not save a bad asset. But stablecoins and blue chips are different. USDC, USDT, Bitcoin, Ethereum, Solana, even Hype now arguably. These are assets that you are confident will be staying stable, or even if they go down in price in the bear market, will come back in price in the next bull run. If I hold one Bitcoin earning yield and it falls 25% in price in 6 months, I'm not worried Another 6 months, we're out of the bear market and its price came back and I made yield the whole way. That is fine. So for liquidity pools, you need to use quality blue chips, stablecoins, or nothing else. Remember, most things in crypto go to zero and no amount of yield makes up for that. Okay, so now you know how to satisfy the first of the two rules. You know you need to be holding assets that will be stable in value like a stablecoin, or are blue chips where the price is going to come back in the next bull run. Now, what about the second rule? Why do market conditions need to be not bullish? Well, when prices move in the market, this liquidity pool is going to be rebalancing your capital automatically. It is part of the rules you signed up for when you deposited your capital into this liquidity pool contract. It will be automatically selling whatever is rising in price and buying whatever is falling in price. You do not choose this. It happens automatically every time a trader on the other side of the liquidity pool trades your capital against you, which is happening by thousands of traders every hour of every day. And the impact of this on the liquidity pool and you as the passive holder of that liquidity pool capital is that you are going to be holding less of whatever is going up in price and more of whatever is going down in price. In a flat market, this barely matters. Prices are going to be somewhat near where you started, and so the dollar value will be as well. You collected fees the whole time, and if your mix between the two assets drift, then when you pull your capital from the liquidity pool, you just rebalance into the split that you want. For example, on day one, let's say you deposit 1 Bitcoin and 10 ETH for a total value of $100,000. But then on month 12, you're going to withdraw from the liquidity pool and you get 0.8 Bitcoin back and 12.5 ETH. Well, the value is still $100,000 because it was a flat market. So who really cares? The value of your capital is still $100,000. So you kept the $100,000 principal, plus you made, say, $20,000 in yield on top. And so you get your $100,000 back, plus an extra $20,000 of yield. No harm, no foul. And a bear market condition is fine as well. Prices fall, and instead of just bleeding, you're going to be dollar cost averaged into assets that you are confident are going to come back in the next bull run. Because the pool is automatically rebalancing every time a trader trades against it, it is going to be buying more of the blue chip asset that is going down in value, dollar cost averaging you into a quality asset and paying you yield on top. That is dollar cost averaging done for you automatically at the right time, plus cash flow yield paid by the trader on top, meaning you're going to be getting paid to accumulate a quality blue chip asset at good prices automatically and being paid cash flow on top to do it. And so by the time the bear market bottoms, you're going to have more of a quality blue chip at great prices when you are also being paid cash flow on top, which you can use to buy more of the blue chip. So liquidity pools are fine for bear market conditions. But when the bear market ends and conditions change to be bullish, you do not stick it out in the liquidity pool. You take the crypto that you've been accumulating, you take the yield that you've been making on top, and then you exit that liquidity pool. You exit that contract, because the bull market is the one time you do not want to be in a liquidity pool. If you're in a liquidity pool during a bull market, you are going to be on the wrong side of that contract. Now, to be clear, you're not going to lose money by being in a liquidity pool when the crypto market turns bullish. You're just going to make less than you otherwise would had you just held those assets spot in a wallet outside of the liquidity pool. Because remember, a liquidity pool is automatically going to be selling whatever is gaining in price and buying whatever is going down in price. And in a bear market, as long as the assets are quality, that's a good thing. You're going to be automatically dollar cost averaging into a high quality blue chip plus making yield on top. But in a bull market, you're going to be selling the winners when you shouldn't be. And this type of opportunity cost even has a name. It's called impermanent loss. And it is the difference between how much you have made by being in the liquidity pool versus what you could have made in a bullish condition had you just held onto the assets in your wallet outside of the liquidity pool. And so to drive this home, when the market turns bullish, pull your capital out of the liquidity pool and hold spot. Let's do a financial demonstration of this now. So what we're looking at here is a calculator that is going to show you what will happen or how much money you'll make when you deposit your blue chip crypto capital into a liquidity pool versus just holding it. And the assets we're going to look at are ETH and USDC, but it doesn't matter. You can apply this to any blue chip stable asset. It doesn't matter. It's just an example. The only difference here is if you're investing into crappy assets and going into those liquidity pools, because remember, those assets are probably going to zero. So focus on the blue chips and focus on stable coins. The playbook, and I'll demonstrate this with numbers, is to first take the profits that you've just made in the last bull market and take it into 50% blue chip, 50% into cash. Because You've just finished a bull market. You're now going into the bear market. So you know that bear markets are okay or good for liquidity pools. So then you put that capital into a liquidity pool and you're going to ride that down to the bottom of the bear market. At the bottom of the bear, it's then going to go bullish again, right? So you're not going to hold the liquidity pool in a bull market like we just covered. You're going to move that liquidity pool into all blue chips or all cash at the bottom of the bear market. And then you're going to ride that up through the next bull market, and then you're going to repeat. So that's the playbook. It's actually very simple. It plays out over years. And here's what I'll show you. This is what happens with money. So let's just say it's October 2025. You've just finished the last bull run with $100,000. Now it's the bear market, and we're in the bear market right now. And we put out a video months ago. We told all of our members months ago, like, this is a bear market. You got to swap to making yield. And this is why. This is why we recommend that. So in a bear market, let's say Ethereum is going to drop down by 60%. A bear market drawdown is this savage. As if you're in crypto investing, watching this, you know this. Let's say when I exit the next bull market, so that's going to be, who knows, like October 2029 is when the next bull run will be over. Who knows, just a guess. Let's say that Ethereum has gained 300%. And let's say the entire time a liquidity pool was paying 25%. Sometimes they can pay a lot higher, but let's just say 25%. Let's say the bear market length was 12 months. We can pick the different months here, but typically bear markets are about 12 months long. And typically bull markets are 3 years long. That's just how these crypto cycles play out. Don't know if it'll be that way in the future, but historically, that's how they play out. Here's how this works out for you financially, depending what path you take. Let's take a look at this option here. If you held all ETH, so you've got here at the starting line, you've got $100,000 in ETH. If you hold 100% of your bull market profits in crypto, and it does a 60% drawdown, well, at the bottom of the bear market, your $100,000, it became $40,000 down here. It became $40,000 because you had a 60% drawdown. But then you go into the bull market. And so for 3 years, you're in a bull market, slowly grinding its way up. Just 2022 to 2025 is just what we went through. Bitcoin went from 17,000 to 126,000. You're going to grind your way back up, and you're going to end up at $300,000. So it grinded its way back up. Let's take a look at the dotted line here. Let's say you go into a liquidity pool the whole time. So at the start of the next cycle, so at the end of the last bull market, you take your $100,000 and you put $50,000 into Ethereum, $50,000 into USDC. Now, by the bottom of the bear market, because you went into a liquidity pool, first of all, of that 50,000 USDC, that was being dollar cost averaged into ETH the whole way down. You weren't all Ethereum at the start. So that saves you from losses. Plus, you're making yield on top, that 25% yield the entire time. And so by the bottom of the bear market, you're only down to 83,651. So you've still lost money, like in dollar terms, but you have lost significantly less than if you just held 100% Ethereum the whole way down. Now, we flash forward over the next 3 years, and look what happens. Because you stay in the liquidity pool, you actually end up underperforming just holding spot ETH the whole way through. And so just if you stay in the liquidity pool the entire way down, so all the way through the bear market, all the way through the bull, you actually underperform just holding Ethereum the whole way down, which is a way simpler thing than managing your liquidity pool positions. And so you shouldn't do that either. You just shouldn't hold spot the whole way, and you shouldn't be in a liquidity pool the whole time. What you need to do is enter a liquidity pool at the start of the bear market. Hold the liquidity pool down. Again, you'll have minimal losses here. It'll go from 100 to 83. But because you are dollar cost averaging into a quality blue chip asset, Ethereum, when the bull market comes back, if you exit this liquidity pool, taking the yield, taking the Ethereum you've been dollar cost averaging into, and you exit that liquidity pool with that extra ETH, with that extra yield, and you go all in on ETH, well, then that's how you get to an outcome of $627,000, making over double what you would have made if you just held ETH the whole way through or just held the liquidity pool the whole way through. And here's the difference, right? If you hold all ETH throughout the cycle, if you're just a holdler, you'll still make money over time. It's going to take you years. If you just do liquidity pools the whole way, you're going to make $282,000, even worse. But if you're smart and you know how to use these products, you go liquidity pools for the bear market and then spot for the bull, which is not difficult to do, right? Like this plays out over years. You're going to make over an extra $300,000, significant difference. And so this is how liquidity pools work. People see 30%, 40% yield, and they think, that's too good to be true. And you're right, it is too good to be true. It is not a risk-free 30% yield. But then once people hear it's not risk-free, they think, oh, I'm not going to do that. But then those people seriously underestimate it. If you are confident in the quality of the assets you're holding and of the market direction, which we are over here on my analysis teams, then liquidity pools can be used to seriously amplify the gains you make in crypto investing. Now remember, These types of products are not available on your favorite crypto exchange, the exact same crypto exchanges that I used to advise as the lawyer, because those exchanges are limited by traditional restrictive regulation that was intended for banks and traditional intermediaries, not the blockchain. The current regulatory system is not set up to get you access to products like these through the apps you can download on your phone. If you want to access products like liquidity pools, you need to come to the blockchain directly. And when you come to the blockchain directly, when you come on chain, there are no safety nets. There's no FDIC, there's no SEC, there's no CFTC, there's none of it. But there is fantastic investment opportunity that is resilient and resistant to a lot of the mismanagement and restrictions you're seeing in the traditional markets right now. And so if you want to build a portfolio that is composed of assets that are not only a hedge to the mismanagement and troubles you're seeing in the traditional markets, but is also a growth portfolio, growth assets, because you're getting in early, then a crypto portfolio that is in your self-custody and is amplified by on-chain products like liquidity pools is probably what you're looking for. And so thank you for watching. Please subscribe. I'll be here by your side as you continue crypto investing.